Welcome to Secrets to Wealth, the place where we uncover the keys to financial freedom and a life of abundance. Today, we're diving into a topic that can completely change your future: 10 financial lessons you need to know before turning 30. Your 20s are the foundation of your financial life, and the habits you build or the mistakes you make during this time will echo for decades. Imagine two versions of yourself: one who understands money, manages it wisely, invests early, and sets clear goals, and another who ignores it all. By the time you reach 40, one version could be financially free, while the other might still be struggling paycheck to paycheck. Which version do you want to be? Stay with me until the end of this video, because these 10 lessons can save you years of stress and put you on a much faster path to success. These aren't abstract theories, but practical principles that countless people have used to build real wealth before 30. And if you find value in this video, make sure to like, subscribe, and turn on the notification bell so you never miss out on what's coming next. Now let's begin with the very first lesson, the foundation of all financial success: mastering the art of budgeting. Mastering the art of budgeting is the foundation of every strong financial future, and yet it is one of the most overlooked skills. A budget is not a prison, it is a map, and without a map, you cannot expect to reach your destination. Too many people in their 20s spend money impulsively, thinking they have plenty of time to figure it out later, but later usually arrives with debt, stress, and regret. A budget gives you control, and control is freedom. Start by tracking every dollar you earn and every dollar you spend. It may feel tedious at first, but awareness is power. You cannot change what you do not measure. Once you know where your money is going, you can make intentional choices about how to use it. The key is to divide your income into clear categories. Essentials like rent, food, and transportation come first. Next, allocate a portion towards savings and investments, even if it feels small in the beginning. The habit matters more than the amount. After that, set aside money for wants and lifestyle choices, because life should still be enjoyable. The mistake most people make is flipping this order. They spend first, then save what's left, which usually ends up being nothing. Pay yourself first, and you'll always be moving forward. Technology makes this easier than ever. Budgeting apps and digital banks allow you to automate savings, track expenses, and visualize progress in real time. But the real transformation comes from your mindset. Budgeting is not about restriction. It is about alignment. It is about making sure your money reflects your values and long-term goals instead of being lost in meaningless purchases. When you give every dollar a job, you stop asking, "Where did my money go?" and start telling it exactly where to go. Imagine the compound effect of this discipline over 10 years. Someone who budgets and saves consistently in their 20s can build a financial cushion that grows into investments, businesses, or property by their 30s. Someone who ignores budgeting will likely carry debt, stress, and missed opportunities into the same decade. The difference is massive. Your budget is your first tool to build wealth, and once you master it, every other financial lesson becomes easier. So remember, freedom starts with control, and control starts with a budget. If you want to take your first real step toward financial independence, create a budget today and stick to it. That is lesson number 1. Now let's move on to lesson number 2, building an emergency fund. An emergency fund is your financial safety net, the cushion that protects you when life throws unexpected challenges your way. Without it, a single setback, like a car repair, a medical bill, or losing your job, can push you into debt and derail your progress. With it, you have peace of mind and the ability to handle life's surprises without panic. Think of it as self-insurance, a shield that keeps you standing when others might crumble. The question is, how much should you save? The general rule is to build a fund that covers 3 to 6 months of essential living expenses. For some, that might sound overwhelming, but remember, you don't need it all at once. Start small. Aim for $500, then $1,000, then keep building. Every deposit, no matter how small, is progress toward financial security. The habit of saving regularly is more important than the speed at which you save. Keep your emergency fund separate from your spending money. Open a dedicated savings account so you're not tempted to dip into it for everyday wants. This money is not for vacations, shopping, or nights out. It's for true emergencies only. Discipline is what makes it effective. When the time comes and you genuinely need it, you'll be grateful it's there. Having an emergency fund also gives you freedom to make better decisions. If you hate your job, you won't feel trapped because you have a cushion to fall back on. If an opportunity arises, like starting a side business or moving to a new city, you'll be able to take that risk with less fear. Without a safety net, most people stay stuck because they can't afford to take chances. Your emergency fund is not just about survival, it's about opportunity. Picture this. Two people both lose their jobs. One has no savings and immediately spirals into credit card debt, stress, and desperation. The other has 6 months of expenses saved and calmly begins the job search without panic, knowing they have time. Which situation would you rather be in? The answer is clear. An emergency fund is one of the most powerful gifts you can give yourself before 30. It builds confidence, reduces stress, and gives you room to breathe when life gets tough. Start today. Build it step by step and watch how much stronger and more secure your financial foundation becomes. That is lesson number 2. Now, let's move on to lesson number 3, understanding credit and debt. Credit and debt are two sides of the same coin, and understanding how they work can mean the difference between financial freedom and financial slavery. Credit, when used wisely, can open doors to opportunities, buying a home, starting a business, or even qualifying for better interest rates that save you thousands of dollars over time. Debt, when used carelessly, can trap you in a cycle of payments, fees, and stress that steals your future. The key is learning how to control credit instead of letting it control you. First, let's talk about credit scores. Your credit score is like a financial report card that lenders use to decide whether they can trust you. A good score gives you access to lower interest rates, higher credit limits, and better financial options. A bad score limits your choices and costs you more money in the long run. Building good credit starts with paying your bills on time, every time. Even one missed payment can hurt your score. Keep your credit utilization low, ideally under 30% of your available credit, and avoid opening too many accounts too quickly. Over time, these small habits add up to a strong credit profile. Now, let's address debt. Not all debt is created equal. There's good debt, like a mortgage or a student loan that can increase your long-term earning potential. And there's bad debt, like high-interest credit cards or payday loans that drain your resources. The mistake many young people make is treating credit like free money, swiping the card without thinking about how long it will take to pay off. The interest adds up fast, and suddenly that $50 purchase turns into hundreds of dollars in debt. The smartest way to handle debt is to avoid bad debt whenever possible. And if you already have it, create a plan to pay it down aggressively. Focus on the highest interest debt first while making minimum payments on the rest, or use the snowball method by paying off the smallest balance first to build momentum. Both approaches work. The key is consistency. Every payment is one step closer to freedom. Credit can be your ally or your enemy. It depends on how you use it. A strong credit history helps you secure loans for major investments like property or business ventures, while reckless debt destroys your financial stability. The choice is always in your hands. Learn the rules early, and you'll avoid years of regret. That is lesson number 3. Now let's move on to lesson number 4, the importance of starting to invest early. Investing early is one of the most powerful decisions you can make for your financial future because time is the greatest multiplier of wealth. The earlier you start, the more you benefit from compound growth, where your money earns returns, and those returns begin earning returns of their own. This snowball effect can turn small, consistent contributions into a fortune over the course of decades. Waiting even a few years to begin can cost you hundreds of thousands or even millions by the time you retire. Many young people hesitate to invest because they think they don't have enough money, or they believe investing is only for the wealthy. The truth is, you don't need thousands of dollars to begin. With modern investment apps and platforms, you can start with as little as $5 or $10. The key is consistency. Regular contributions, no matter how small, create the habit and momentum that grow wealth over time. Start with simple, proven investment vehicles. Low-cost index funds or exchange-traded funds spread your money across hundreds of companies, reducing risk while capturing long-term market growth. If your employer offers a retirement plan with matching contributions, like a 401k, take full advantage of it. That match is free money, and ignoring it is like walking away from part of your salary. If you're self-employed, consider setting up your own retirement account to reap tax advantages while saving for the future. The most important factor in investing is not timing the market. It is time in the market. No one can predict the short-term ups and downs, but history shows that over the long run, markets rise. By staying invested and resisting the urge to panic when prices drop, you allow your money to recover and grow. Patience and discipline are far more valuable than trying to outsmart the market. Think of investing as planting a tree. The best time to plant was 20 years ago, and the second best time is today. The earlier you plant, the stronger and larger it grows, providing shade and fruit for years to come. By starting to invest in your 20s, you give yourself decades of growth that people who wait until their 30s or 40s can never fully recover. Investing early is not about getting rich overnight. It is about building wealth gradually, steadily, and securely. It is the bridge between working for money and letting your money work for you. That is lesson number 4. Now let's move on to lesson number 5. Understanding the power of compound interest. Compound interest is often called the eighth wonder of the world, and for good reason. It is the force that quietly builds wealth in the background, turning small amounts into life-changing sums over time. The principle is simple. When you invest money, you earn returns, and those returns get reinvested, allowing you to earn returns on your returns. This cycle repeats year after year, creating exponential growth that accelerates the longer you stay invested. To understand the power of compound interest, imagine 2 people. One starts investing at age 20 and contributes just $200 a month until they're 30, then stops. The other waits until age 30 to start and invests the same $200 a month all the way until retirement at 65. Who ends up with more money? Surprisingly, the person who invested earlier but stopped after 10 years ends up with more wealth because their money had more time to compound. That is the magic of starting early. The key to harnessing compound interest is patience. In the beginning, the growth may look small and unimpressive, but over decades it becomes unstoppable. The first few years are about building a base. Then the curve begins to bend upward, and suddenly your money grows at a pace you never thought possible. It is like rolling a snowball down a hill. It starts small, but the farther it rolls, the larger and faster it becomes. This is why delaying investments is so costly. Every year you wait, you lose not just the contributions, but the compound growth that would have accumulated on those contributions. Time is your most valuable asset, and once it is gone, you can never get it back. That's why understanding compound interest before you turn 30 is critical. It allows you to use time as your greatest advantage. The principle of compounding also applies beyond investing. It affects your debts as well. Credit card balances, payday loans, and other high-interest debts compound against you, growing larger and harder to escape the longer you carry them. Just as compounding can build your wealth, it can also destroy it if you are not careful. The lesson is simple. Let compound interest work for you, not against you. Compound interest is not magic. It is mathematics and discipline. Start early, be consistent, and give your investments time to grow. Over the years, you will see how powerful this force truly is. That is lesson number 5. Now let's move on to lesson number 6, developing multiple streams of income. Relying on a single source of income is one of the greatest financial risks you can take. Because if that income disappears, your entire lifestyle collapses with it. Developing multiple streams of income gives you stability, flexibility, and the ability to build wealth much faster than relying on just one paycheck. The wealthy understand this principle deeply. Most millionaires and billionaires don't depend on only one income source. They build many, and those streams together create financial security and growth. The first step is to strengthen your primary income, usually through your career or business. Work on developing skills that increase your earning potential because your main income stream often provides the capital to build additional ones. But don't stop there. Look for ways to diversify. Side hustles, freelance work, or part-time businesses can add meaningful income without replacing your main job. Investments are another powerful stream of income. Dividends from stocks, interest from bonds, or rental income from property are examples of money working for you instead of you always working for money. The beauty of investment income is that it can eventually become passive, requiring little effort once it is set up. Imagine earning money while you sleep. That is the true goal of multiple streams of income. In today's digital age, opportunities to create new income sources are greater than ever. Online businesses, digital products, affiliate marketing, and content creation allow you to reach global markets with minimal upfront costs. Skills like writing, design, programming, or teaching can all be monetized online. What once required huge investments now only requires creativity and consistency. The key is not to overwhelm yourself by trying to do everything at once. Start small, test ideas, and build gradually. One reliable extra income stream can relieve financial pressure and accelerate your savings and investments. Over time, as you build more, your dependence on a single paycheck decreases, giving you true financial freedom. Multiple streams of income also give you resilience. If one stream slows down or disappears, the others keep you afloat. This is how wealthy people protect themselves from financial storms. Instead of panicking, they simply adjust and keep moving forward. Building multiple streams of income is about shifting from a survival mindset to a wealth mindset. It is about creating options, building security, and opening doors to opportunities you never thought possible. That is lesson number 6. Now let's move on to lesson number 7. Living below your means. Living below your means is one of the most important habits you can build because no matter how much money you make, if you spend it all, you will never be wealthy. Too many people fall into the trap of lifestyle inflation, where every raise or bonus immediately turns into a bigger car, a nicer apartment, or more expensive clothes. They look rich on the outside, but are broke on the inside. True wealth is not about how much you spend. It is about how much you keep and grow. The principle is simple. Spend less than you earn and invest the difference. This doesn't mean living miserably or denying yourself every pleasure. It means making conscious choices, prioritizing what truly matters, and avoiding unnecessary expenses that don't add long-term value to your life. When you live below your means, you give yourself the ability to save, invest, and take advantage of opportunities when they arise. Think of it this way. Every dollar you don't spend is a soldier you can send out to work for you. Over time, those soldiers multiply and create an army that builds your wealth. But if you spend everything, you are left defenseless, always dependent on your next paycheck. Financial freedom requires discipline, and discipline means resisting the urge to keep up with others or impress people who aren't paying your bills. Living below your means also reduces stress. When you aren't stretching your finances to the limit, unexpected expenses don't hit as hard. You have room to breathe, room to save, and room to plan for the future. It allows you to focus on building wealth instead of constantly worrying about surviving. This lesson is especially powerful in your 20s, when the temptation to show off or live beyond your income is at its highest. If you can resist that urge and focus on building a solid financial foundation, your 30s and 40s will be much easier. Sacrificing short-term luxuries for long-term security is a trade that always pays off. Remember, it's not about how much money you make, it's about how much you keep. Living below your means is the habit that makes every other financial lesson work. That is lesson number 7. Now, let's move on to lesson number 8. Continuously improving your financial literacy. Improving your financial literacy continuously is one of the smartest investments you can ever make because the more you understand money, the better decisions you will make with it. Most people graduate from school knowing how to solve equations or analyze literature, but with little to no knowledge of how credit works, how to invest, or how to plan for retirement. As a result, they learn through painful mistakes, falling into debt, missing opportunities, and living with regret. By choosing to educate yourself about money, you give yourself an advantage that most people never take. Financial literacy is not something you learn once and then forget. The world of money is always changing, with new tools, opportunities, and risks appearing all the time. What worked for your parents may not work for you, and what works today might need adjusting tomorrow. That's why continuous learning is essential. Read books about personal finance, wealth building, and investing. Follow credible financial educators and experts. Listen to podcasts, watch videos, and take online courses that expand your understanding. The more you learn, the more confident you become in managing and growing your wealth. The key is not just consuming information, but applying it. Knowledge without action changes nothing. If you learn about budgeting, create one. If you learn about investing, open an account and start small. If you learn about debt management, put a repayment plan in place. Every small action builds momentum and reinforces what you've learned. Another part of financial literacy is surrounding yourself with people who are also focused on growth. Join communities, forums, or groups where money and success are discussed openly. Being around people who understand and value financial wisdom will keep you motivated and help you avoid the mistakes that come from isolation or bad influences. Think of financial literacy as a lifelong journey. There is no finish line, only progress. The more skilled you become, the more doors open for you, and the less likely you are to be trapped by financial ignorance. That is lesson number 8. Now let's move on to lesson number 9, protecting yourself with insurance. Insurance is one of the least exciting topics in personal finance, but it is absolutely essential for protecting everything you are working so hard to build. Without insurance, a single accident, illness, or unexpected event can wipe out your savings and destroy years of progress. With insurance, you have a safety net that allows you to recover and move forward without financial ruin. Think of it as a shield, something you hope you never need, but are deeply grateful for when life happens. There are a few types of insurance that everyone should understand. Health insurance is critical because medical bills are one of the leading causes of bankruptcy. Even if you are young and healthy, one accident or unexpected illness can create costs that you cannot pay out of pocket. Car insurance, if you drive, is not just required by law in most places, but also protects you from massive expenses after an accident. Renters or homeowners insurance protects your belongings and property, giving you peace of mind that your home and possessions are safe. Life insurance becomes important if you have dependents who rely on your income, such as a spouse or children. It ensures that if something happens to you, they are not left in financial hardship. Disability insurance is another type many overlook, but it protects your income if you are unable to work due to injury or illness. Since your ability to earn money is your most valuable asset in your 20s, protecting it is just as important as protecting your possessions. The goal is not to insure everything, but to insure against risks you cannot afford to cover yourself. If losing something would be devastating financially, it probably needs insurance. If losing it would be inconvenient but manageable, insurance may not be necessary. Understanding this balance helps you avoid overpaying while still being protected. Many young people ignore insurance because they see it as an expense instead of protection. But the truth is, insurance is part of a strong financial foundation. It safeguards your wealth, your health, and your peace of mind. Without it, you are gambling with your future. With it, you are securing everything you've worked for. That is lesson number 9. Now, let's move on to lesson number 10. Setting long-term financial goals. Setting long-term financial goals is the final lesson in building true wealth, and it's what ties everything together. Without a clear goal, all the strategies, budgeting, investing, saving, can feel aimless. Goals give your financial efforts direction and purpose. They help you stay focused, even when life gets tough or when you're tempted to spend impulsively. The key is not just to set goals, but to set smart goals, specific, measurable, achievable, relevant, and time-bound. Start by thinking about where you want to be in 5, 10, or even 20 years. Do you want to own a home? Start a business? Retire early? Pay off all your debt? Whatever your vision, break it down into actionable steps. For example, if your goal is to retire early, figure out how much money you need to save and invest each month to reach that target. It might feel overwhelming at first, but the key is to start with the end in mind and reverse engineer the process. Financial goals need to be broken into smaller milestones, and those milestones should be tracked regularly. It's easy to lose sight of your bigger goals if you don't monitor your progress. Whether you review your goals quarterly or annually, make sure you adjust them as needed. Life changes, and your financial goals should evolve with you. Having long term goals also gives you the ability to say no to things that don't align with your vision. When you're clear on where you want to go, it's easier to make decisions. Instead of getting caught up in the latest trends or spending money on fleeting pleasures, you can focus on your goals with confidence. Every financial choice becomes a step toward your bigger dream. The power of long term goals lies in their ability to guide your daily decisions and help you make sacrifices today for a better tomorrow. They provide clarity, motivation, and a sense of purpose. Setting goals isn't just about numbers on a page, it's about shaping the life you want to live. That's lesson number 10, setting long term financial goals. With all 10 lessons in hand, you now have the tools to take control of your financial future. Remember, it's never too late to start, but the sooner you begin, the greater your chances of building the life you've always dreamed of. Thank you for sticking with us. If you found these lessons valuable, make sure to like, subscribe, and share this video with anyone who could benefit from it. And as always, leave a comment below with the financial lesson that resonated with you the most. Keep learning, keep growing, and stay on the path to financial freedom. That's it. You now have the 10 essential financial lessons that can set you on the path to financial freedom before you hit 30. If you've taken these lessons to heart, you're already ahead of the game. But remember, wealth doesn't build overnight. It takes time, discipline, and a commitment to your goals. Keep budgeting, keep investing, and keep learning. And as you move forward, always make sure your actions align with the life you want to create. Before we wrap up, I want to remind you that the journey to financial success is a marathon, not a sprint. Every decision you make, no matter how small, is a building block toward your ultimate goal. And just like a house needs a strong foundation, your financial future needs solid principles and strategies. Stick to the plan, and over time, you will see the results. Thank you for joining me in today's video. If you enjoyed the content, don't forget to like, subscribe, and hit the notification bell so you're always the first to know when new insights drop. And if you have any questions, comments, or thoughts about these lessons, drop them below. I'd love to hear from you. Let's keep growing together and unlocking the secrets to true wealth. Stay focused, stay disciplined, and keep moving forward. That's all for today's video. Thank you so much for watching and being part of this journey toward financial freedom. If any of these lessons resonated with you, or if you're already applying them in your own life, let me know in the comments below. I love hearing your stories and experiences, and it helps others who are just getting started. Remember, financial freedom is a choice. It's about making small, smart decisions consistently over time. So, stay disciplined, stay patient, and trust the process. You're capable of achieving anything you set your mind to, and I'm here to help guide you every step of the way. Until next time, keep learning, keep growing, and keep building your wealth. I'll see you in the next video. Stay wealthy, stay wise, and take care.